Something big has changed in gold and silver. Metals update. Gold moved, silver moved, but the real story is not the drop everyone saw. It is the reaction that should have happened and didn't. Because when fear rises, when pressure builds, when the global system starts showing cracks, these metals usually reveal the truth immediately. This time they told a different story, a quieter story, a more dangerous story. One that suggests serious money may already be repositioning while the public is still looking the wrong way. And if that is true, then what comes next for gold, silver, and the wider economy could surprise almost everyone. Before we continue, welcome to Financial Crisis Explained. And to the viewers who value wisdom over noise, subscribe to the channel the way a careful man locks his door before nightfall, not out of fear, but out of experience. And one more thing, from where in the world are you watching today? Drop your city and country in the comments below. Because what is happening here may be much bigger than it first appears. Something big had changed in gold and silver, and the first sign of it was not strength, but restraint. On the surface, the session looked ordinary enough. Gold slipped, silver slipped. Financial headlines, as they often do, reduced the move to a familiar sentence about profit-taking, temporary weakness, or shifting expectations around interest rates. To the casual observer, it was simply another day in the metals market. Prices were down, therefore the story was bearish. That was the easy conclusion, and also the dangerous one. Because in serious markets, the most important signal is often not what moved. It is what refused to move as much as it should have. That was the anomaly. That was the warning. Under normal conditions, precious metals do not exist in isolation. They respond to pressure within a larger system. Conflict risk, sovereign stress, inflation expectations, energy instability, debt fears, currency uncertainty, and global liquidity conditions. When those risks intensify all at once, markets usually react with far more force. Weakness becomes sharper. Volatility becomes disorderly. Defensive assets either surge on panic or collapse under liquidation pressure. But what had just happened in gold and silver did not fully fit either pattern. They declined, but they remained unexpectedly firm. And for those who knew how to read markets beyond the headline number, that firmness mattered more than the decline itself. This was not a story about whether gold had closed higher or lower on a single day. It was a story about market character. Character is what emerges when an asset is placed under stress and reveals how much hidden demand exists beneath the surface. A shallow decline during a period of elevated macroeconomic tension can say more than a dramatic rally during calm conditions. One is emotional, the other is structural. That distinction matters to businessmen, investors, and entrepreneurs because structural signals tend to appear before public narratives adjust. By the time the public is told that a trend has changed, disciplined capital has usually already moved. What made this moment so unusual was the backdrop. The global environment was not stable. Trade routes remained vulnerable. Strategic tensions were not resolved. Energy-sensitive regions remained exposed to disruption. Debt burdens across major economies were still historically heavy. Monetary authorities, despite their confidence in public messaging, were operating with less room for error than they had enjoyed in previous cycles. In such a world, a visible drop in gold and silver should have inspired confidence only if it was accompanied by a convincing improvement in the larger system. There was no such improvement. The risk had not disappeared. The pressure had not been resolved. The market simply absorbed the blow better than expected. And that raised the central question of this entire story. Who was still buying weakness, and why? That question matters because modern markets are layered. There is the public layer, where people react to charts, headlines, and short-term commentary. Then there is the institutional layer, where positioning decisions are made based on liquidity, reserves, supply conditions, and long-duration risk. When the public sees decline but the asset refuses to break decisively, it often suggests that stronger hands are active underneath, not loudly, not emotionally, quietly. That kind of buying does not chase headlines, it prepares for consequences. For years, many market participants were trained to interpret gold and silver through a narrow framework. If the dollar strengthened, metals should weaken. If yields rose, metals should struggle. If risk appetite returned, defensive assets should soften. That framework still contains truth, but only part of it. What had just happened suggested that another force was now competing with the old logic. Something larger was beginning to hold the market together. It may have been sovereign demand. It may have been reserve diversification. It may have been industrial positioning in silver. It may have been a growing recognition that the next phase of economic instability would not look like the last one. But whatever the exact mix, the message was the same. The floor under these metals appeared stronger than many expected. That should concern anyone whose business depends on stable input costs, predictable financing conditions, or confidence in the purchasing power of money. Precious metals are not simply commodities. At key moments in history, they function as indicators of distrust. When they behave abnormally during stress, they often signal that informed capital is reassessing the safety of the broader system, and that is what made this moment different. The drop in price attracted attention, but the refusal to collapse deserved far more of it. To the untrained eye, nothing extraordinary had happened. Gold was down, silver was down. End of story. But to those who study how markets behave when pressure is real, the conclusion was very different. A market that should have shown more weakness had instead shown resilience. A defensive asset that should have cracked had instead absorbed. And when an asset begins absorbing bad news rather than reflecting it fully, it usually means one thing. The old assumptions are starting to fail. That was the first signal. Not a breakout, not a panic. Not a headline event large enough to force immediate public recognition. Just a subtle inconsistency, the kind that appears near the beginning of major transitions. And in markets, transitions rarely announce themselves with certainty. They begin with small refusals, small distortions, small moments when price no longer behaves the way the old model says it should. Gold and silver had just delivered one of those moments. And for serious decision makers, that was enough to pay attention. There are moments in financial history when the market does not collapse, does not surge, and does not deliver a dramatic headline, yet still reveals that a deeper transition is already underway. This was one of those moments. The true significance of gold and silver was not found in the fact that they moved lower. It was found in the fact that they did not behave according to the old script. For years, investors were taught to read precious metals through a familiar and mechanical framework. If the dollar strengthened, gold should weaken. If bond yields rose, silver should struggle. If markets believed central banks were still in control, metals should remain under pressure. It was a model repeated so often that many stopped questioning it. But markets do not ring a bell when they are changing. They simply begin ignoring old instructions. That is what made this moment different. Gold and silver were no longer reacting as if they were merely speculative instruments trapped inside a narrow set of financial formulas. They were beginning to behave like strategic assets again. That distinction is far more important than most daily commentary allows. A speculative asset depends heavily on mood, momentum, and short-term positioning. A strategic asset depends on trust, scarcity, and the willingness of serious capital to hold it through uncertainty. When an asset shifts from the first category toward the second, it stops responding cleanly to the language of traders and starts responding to the behavior of institutions, sovereign actors, and long-horizon buyers. That is where the old rules begin to fail. Gold, at its core, is not simply a trade against interest rates. It is a judgment on monetary credibility. It becomes more relevant when governments borrow aggressively, when currencies face long-term pressure, and when the public begins to suspect that official stability is being maintained through narrative more than substance. In those conditions, gold is not purchased because it is exciting. It is accumulated because confidence has become conditional. Silver is even more complicated. It lives in two worlds at once. It is part monetary metal and part industrial necessity. That gives it a role no other major asset class can fully replicate. It can attract defensive capital during uncertainty, while also being pulled by demand from manufacturing, electrification, solar expansion, and advanced industrial systems. This dual identity makes silver difficult to price with old assumptions alone. It is not just a safe haven, it is also a strategic material. That matters because the world economy is no longer operating under the same conditions that defined the previous decade. Supply chains have become more political. Energy has become more strategic, trade has become less frictionless, industrial policy has returned, governments are intervening more directly in sectors once left to market forces. In such an environment, hard assets begin to matter differently. This is why a routine explanation no longer feels sufficient. If gold and silver were still responding only to short-term yield expectations, then their behavior would have looked simpler, cleaner, and more predictable. Instead, what the market revealed was resistance. Beneath the visible selling pressure, there appeared to be a layer of support that daily headlines could not fully explain. That support is unlikely to come from emotion. Emotional buyers do not create durable floors. Strategic buyers do, and strategic buyers are rarely interested in a one-day move. They are interested in what happens when debt costs rise, currencies weaken, trade channels fracture, and geopolitical tensions begin affecting physical supply. They are interested in preserving purchasing power, insulating reserves, and maintaining optionality in a world where policy certainty is becoming less reliable. This is the point many smaller investors and even many entrepreneurs miss. A change in the metals market is not just a metals story. It is often a message about the broader operating environment. When gold and silver stop obeying the old model, it suggests that capital itself is reevaluating the future. It suggests that some of the most informed participants no longer fully trust the assumptions that kept the previous system intact. For a business owner, that should not be interpreted as an abstract macroeconomic observation. It should be read as a warning, because if hard assets are finding stronger support during conditions that should have weakened them, then pressures may already be building elsewhere. Credit may become less forgiving, input costs may become less stable, margin planning may become more difficult, customers may begin behaving differently as purchasing power shifts under the surface. None of this requires panic, but it does require seriousness. The biggest market changes usually begin quietly. First, an asset stops falling as easily as it used to. Then it begins attracting buyers on weakness. Then analysts struggle to explain its resilience using the old playbook. And only much later does the broader public realize that the market had been signaling a regime shift all along. That may be what was beginning here. Gold and silver were no longer sending a message about a single session. They were sending a message about structure. The old assumptions still existed, but they were losing control. A new set of forces was entering the picture, and those forces were not temporary. They were rooted in debt, trust, industrial demand, sovereign behavior, and the growing fragility of a system that had relied for too long on confidence remaining automatic. Confidence is never automatic forever. Once the market begins to question it, capital changes its behavior. And when capital changes its behavior, those who continue using yesterday's map often discover the shift too late. That was the deeper meaning of this moment. Gold and silver had not simply moved. They had begun to reveal that the rules governing them were changing. And when the rules change in the metals market, the consequences rarely stay in the metals market for long. Long before the public understands that a financial environment has changed, hard assets begin to behave differently. They do not issue warnings in plain language. They do not explain themselves. They simply start reflecting pressures that the official narrative is still trying to contain. That is what makes gold and silver so important in periods like this. They are not merely investments. They are instruments of detection. They reveal when confidence is weakening beneath the surface, even while governments, institutions, and media commentary continue projecting stability. And what they were beginning to reveal now was not a narrow market story. It was a much wider repricing of global risk. The world economy had entered a phase where several forms of pressure were no longer isolated. Debt pressure, currency pressure, trade pressure, and geopolitical pressure were starting to converge. On their own, each of these forces is manageable for a period of time. Together, they create a system that becomes more fragile than it appears on paper. The first layer of that fragility is sovereign debt. Many of the world's major economies are carrying debt burdens that would have been considered extraordinary in earlier eras. Governments can continue financing large obligations as long as borrowing costs remain tolerable and confidence in repayment remains intact. But when interest rates rise, deficits persist, and growth weakens, that balance becomes harder to maintain. A highly indebted system does not need an immediate crisis to become unstable. It only needs enough pressure to make future credibility more expensive. That is where gold begins to matter. Gold becomes stronger not only when inflation is high, but when confidence in the long-term discipline of financial management starts to weaken. It represents distance from policy promises. It gains relevance when capital begins to ask whether governments can truly restore balance without damaging growth, debasing currency value, or forcing financial repression in one form or another. Silver enters the picture from another direction. Its significance expands when industrial systems become more strategic. This is no longer a world where commodities can be viewed purely through the lens of ordinary business cycles. Supply chains are now deeply connected to politics, energy security, and national competitiveness. Critical materials are no longer just economic inputs. They are strategic assets. Silver sits at the center of that reality. It is essential to technologies associated with modern industrial expansion, including energy transition systems, electronics, and advanced manufacturing. That means silver is influenced not only by investor sentiment, but also by physical demand rooted in long-term industrial policy. In a fragmented world where states are trying to secure access to strategic resources while reducing dependence on vulnerable supply routes, that matters enormously, and supply routes themselves are no longer a background detail. They have become part of the story. Global trade depends on the assumption that goods, energy, and raw materials can move efficiently through predictable corridors. But when shipping lanes face repeated disruption, insurance costs rise, delivery times become less certain, and commodity pricing starts incorporating political risk more directly. The effect is not always immediate, but it is cumulative. Markets begin to price not only present supply, but the possibility of interrupted supply. This is where the signal in hard assets becomes more serious. If trade fragility increases while debt remains high and currencies face long-term purchasing power concerns, then the demand for neutrality rises. Gold and silver offer a form of neutrality that paper claims cannot fully provide. They do not depend on a central bank promise, a corporate balance sheet, or a sovereign bond market staying trusted forever. That is why when the system feels more conditional, hard assets quietly become more attractive. There is another force working beneath all this, the growing hesitation around the global monetary order itself. For decades, much of the international system operated on the expectation that reserve currencies, cross-border settlement networks, and major government debt markets would remain the unquestioned center of trust. That trust has not vanished, but it is no longer absolute. Sanctions policy, political fragmentation, reserve diversification, and strategic rivalry have all encouraged some governments and institutions to rethink how much dependence they are willing to maintain on any one financial architecture. That does not mean a dramatic overnight replacement of the existing order. Markets rarely change that way. What it means is something more subtle and more important. Optionality is being rebuilt. States, institutions, and long-horizon actors are increasing their room to maneuver. And when serious actors seek optionality, they often move toward assets that cannot be printed, diluted, or sanctioned in the same way as financial claims. This is why the repricing of gold and silver should not be dismissed as a niche concern for commodity traders. It may be part of a broader adjustment in how the world values trust, liquidity, and security. The implications reach far beyond the metals themselves. For entrepreneurs and business operators, this matters in practical terms. A world that increasingly rewards hard assets is often a world where paper forecasts become less dependable, currency stability becomes more uncertain, imported costs become harder to predict, debt refinancing becomes more expensive, consumer behavior becomes less confident. Businesses that depend on smooth credit conditions and stable planning assumptions often struggle when the environment begins shifting this way. The most disciplined decision makers understand that market signals like these are not instructions to panic. They are instructions to prepare. A resilient bid under gold and silver can indicate that serious capital is already adjusting to a world of higher friction, lower trust, and greater strategic competition. That kind of adjustment does not remain confined to one asset class. It eventually affects the cost of doing business itself. And that is why this moment deserves far more attention than a normal market update would suggest. Gold and silver were not simply responding to one event, one data point, or one trading session. They were responding to a deeper change in the structure around them. Debt was no longer a distant concern. Trade was no longer reliably neutral. Currency confidence was no longer automatic. Supply security was no longer guaranteed. When those conditions begin to converge, hard assets stop looking old-fashioned and start looking diagnostic. That is what the market was beginning to say. Not loudly, not dramatically, but clearly enough for those willing to listen. And when hard assets begin speaking before the headlines do, history suggests that serious people should pay attention. The most consequential shifts in economic history rarely begin with public consensus. They begin with quiet adjustments made by those who understand that markets do not send invitations before conditions change. By the time the majority feels certain that a transition is underway, the most strategic actors have already repositioned, reduced exposure, protected liquidity, and altered their assumptions about what comes next. That is the final lesson of what gold and silver may be signaling now. This is no longer just a conversation about metals prices. It is a conversation about whether the people who allocate serious capital are beginning to prepare for a different kind of economic environment. If that is happening, then the implications stretch far beyond commodity charts. They reach into credit markets, business planning, currency confidence, consumer demand, and the very structure of financial decision-making. The public usually waits for confirmation. Smart money usually watches behavior. That difference is everything. Confirmation feels safe because it arrives with headlines, expert panels, and broad agreement. But in markets, safety and timing are rarely the same thing. When confirmation becomes obvious, price has often already moved, margins have already narrowed, and flexibility has already become more expensive. Strategic actors understand this. They do not require certainty before adjusting. They require evidence that the balance of risk has shifted. Gold and silver may be offering exactly that kind of evidence. If both metals are showing resilience during moments that should have weakened them more decisively, then the message is not necessarily that an immediate crisis has arrived. The message is that the market may already be assigning greater value to protection, scarcity, and independence from financial promises. That is a serious message. It means trust in the broader system may still exist, but it is no longer being extended without question. For business owners, this distinction matters more than many realize. A stable business environment depends on predictable money, functional credit, manageable volatility, and confidence that future planning assumptions will not be overturned too quickly. But when the market begins valuing hard assets more aggressively, it can signal that some of those assumptions are weakening. It can mean that the future cost of capital is becoming more uncertain. It can mean that inflation risk is not fully under control. It can mean that geopolitical instability is beginning to affect economic behavior more deeply than official commentary suggests. This is why serious decision makers should not focus only on whether gold rises another $50 or silver drops another dollar. That is the smallest part of the story. The larger question is what persistent strength in these metals says about capital behavior. If capital is moving toward hard assets, then somewhere else it may be growing less comfortable. Perhaps it is less comfortable with sovereign debt trajectories. Perhaps it is less comfortable with the long-term purchasing power of currencies. Perhaps it is less comfortable with the durability of global trade routes, or with the assumption that central banks can still manage every instability through communication and balance sheet tools. Whatever the exact concern, the result is the same. Markets begin seeking protection before the public accepts that protection is needed. That is how major adjustments begin. They begin with a subtle refusal in one corner of the market, then they spread into pricing behavior elsewhere. Then operating conditions for businesses become more demanding. Borrowing becomes less forgiving. Consumers become more selective. Procurement becomes less predictable. Growth forecasts become more fragile. And eventually, what once looked like a niche market signal is understood as the early warning of a much broader transition. This is why entrepreneurs, executives, and ambitious young businessmen should pay close attention. Not because they need to become gold traders, but because they need to understand what a shift in hard assets can reveal about the environment in which they are building. In uncertain monetary periods, business strength comes less from optimism and more from discipline. Companies with strong cash management, low unnecessary leverage, resilient supplier relationships, and realistic pricing power tend to survive conditions that damage weaker competitors. They do not survive because they guessed every headline correctly. They survive because they understood the environment early enough to adapt before pressure became obvious. That is the strategic value of studying gold and silver. These metals are not merely reacting to events. They are helping expose the level of trust inside the system that surrounds those events. If trust remains strong, metals behave one way. If trust becomes conditional, they begin behaving another. And when their behavior changes before the public explanation changes, that is often when serious observers should become most attentive. This moment may not look dramatic enough for many people. There may be no official declaration that the old assumptions are failing. No central banker will announce that confidence is becoming more fragile. No major institution will openly frame this as the beginning of a broader repricing of risk until long after the evidence becomes too strong to ignore. But markets do not need permission to change, and smart money does not wait for permission to act. That may be the most important conclusion of all. Gold and silver are not simply telling a story about fear. They may be telling a story about preparation, about a world where debt is heavier, trade is less secure, policy is less flexible, and confidence must work harder to sustain itself. In that kind of world, hard assets begin to matter not because the system has already broken, but because thoughtful capital is no longer willing to assume that it cannot. That is a very different kind of warning, and it is the kind that serious people ignore at their own cost. What looked at first glance like a normal metals update may in fact be something much more important, a quiet signal that the market is beginning to prepare for a harder phase of the economic cycle, one in which stability is more expensive, trust is less automatic, and those who move early will not need to move in panic later. That is why this shift in gold and silver matters, and that is why the smartest people in the room are rarely the ones waiting for the headline to make it official.